Welcome to the Valmika Property Investing Podcast, where I, your host, share the key to success in the Australian property investing market. I'm the founder of Valmika Buyers Agency. You can find us at valmikaproperty.com. The contents of this podcast are the personal opinion of your host and are intended for entertainment purposes only. Any financial advice must be obtained from your trusted financial advisor or a qualified professional. On this week's episode, we're going to discuss the RBA's rate decision and whether we're done with interest rate hikes. Under this section, we'll speak about the RBA's rate decision and give you an in-depth analysis of what led to the pause. In section 2, we'll discuss the cash rate and compare it to the benchmark, which is the US Fed funds rate, just so that we can gauge where we are in the bigger scheme of things. Then moving on to the risks for another hike, which might be higher than what the market is expecting, and I'll explain why. And then lastly, of course, how this will impact the property market. But before moving on to this, let's discuss the auction clearance results for this weekend ending 6th of August 2023. So New South Wales, another strong clearance at 67%, with Sydney clearing at 69%. Moving on to Victoria at 71% clearance rate, with Melbourne at 71.2% clearance rate. Then, of course, Queensland showing a 63.5% clearance rate, with Brisbane at 74.5%. So that is a decent uptick from Brisbane from last week, around a 19% uptick, which is pretty good, strong showing. Then, of course, the strongest clearance rate still in the country is South Australia, clearing at 78%, with Adelaide clearing at 76.7%. Western Australia improving from last week, but still lagging behind the major states. So Western Australia clearing at 50%, which is 11% up from last week, and Perth clearing at 40%, which is a 9% increase from last week. Okay, so moving on to our topic for today. The RBA, as you would have all heard by now, has decided to pause interest rates. This was primarily led due to softening retail sales and a softening in inflation as well. These were the prints that were shown prior to the meeting, so the speculation of a hold increased, which proved to have been the case. But where does this leave us in the bigger scheme of things? So the US is the biggest economy in the world. So, you know the saying, if the US sneezes, the rest of the world catches a cold. So this applies to benchmarking our interest rates against that economy. It's obviously not a one-to-one comparison because the dynamics of the US economy are slightly different, particularly with regards to mortgages. Mortgages in the US are fixed over the term for 30 years, whereas in Australia, people tend to fix their mortgages from 3 to a maximum of 5 years, and then it's primarily floating interest rates. However, if we were to compare the RBA's cash rate, which is at 4.1%, to the US Fed funds rate, which is it trades in a range, and that's in 5.25 to 5.5%, you can see that we're quite a bit lower than where the US Fed is. So what does this actually mean going forward? So I actually believe, and primarily one of the reasons being that we are behind the rest of the world, and how we can compare that is looking at real rates. So our real rates are actually still negative. So what do I mean by real rates? So if we look at our inflation prints, so our inflation, most recent print was around 5.9 to 6%. However, our cash rate is 4.1%. So the real yield in this aspect, looking at it on a simple basis, is 4.1 less than 5.9, which equates to a negative 1.8% real yield. So that actually shows that we're still in stimulatory territory when compared to inflation. However, if we had to compare ourselves to the US cash rate, let's take the bottom of the range at 5.25, sorry, it's called the Fed funds rate, is at 5.25 and the inflation is at 2.97. So that means their real yields are positive 2.28, which is in restricted territory because it's positive. So that just shows that Australia is in a less restrictive, or not even that much in a restrictive environment when compared to the US and other major economies. So, and the reason for this is primarily got to do with the way we treat our mortgages. So we're a lot more sensitive to interest rates than other developed countries around the world. However, on this basis, we're still pretty low and inflation is still very high. So the market's currently pricing in a 20% chance of another hike. I tend to think it's higher than this, and it's got to do with real yields. It's got to do with us being below the rest of the world, and it's got to do with us having a high inflation rate. The other important factor to think about when considering that our cash rate is still pretty low when compared to the rest of the world, it's got to do with our wage increases that are coming forward that will be reflecting in the new inflation numbers going forward. So the new minimum wage is coming through now and will be reflected in the next CPI print, to my understanding. So you're coming from a lower base of minimum wage to a higher base of minimum wage. So this is going to be reflected in the new CPI numbers. And then also to consider the inflation print going forward will have a increase or potential increase in inflationary pressures due to the high energy prices that we've experienced. Why have we had high energy prices? Well, it's a combination of a few things. One, there's been cuts to production from two of the major OPEC countries, mainly Russia and Saudi Arabia. So they are producing less barrels of oil per day, so decreasing the supply, which puts the pressure on prices to go up because the demand is outstripping the supply. Secondly, and this is maybe having a more volatile impact on inflation going forward, it's got to do with the Chinese economy. So the Chinese economy hasn't been performing as expected when compared to the rest of the world when coming out of COVID. So they've had a pretty weak economy coming out of COVID. And on the back of this, we're getting bits and pieces of news every week, whereby they are stimulating the economy in various different ways. And those announcements of stimulus, if you notice and you watch when that comes out, the oil prices tend to increase because increase the risks that China will need more oil as their economy gets stimulated. So there's definitely inflationary pressures on the horizon. The counter argument to that is that you are seeing a weakening in Australia's economy. You're seeing retail sales declining. You are seeing inflation coming off in general, but not as quickly as people are expecting, especially on service side inflation. That's tending to be pretty sticky. So for these reasons, I believe that the risks for another hike at least are higher than what the market is expecting. But having said that, whether we don't get another hike now or there is one more hike, we are basically close to the top of the hiking cycle. And the market looks through this. So the market will be looking to when interest rates will start to filter through from the RBA. And that's likely to be at this stage and where the traders are marking it second half of next year. So how does this all impact property market? So I'm from anecdotal evidence from me being in the market every day, I am seeing evidence that interest rates are starting to hurt households in an extreme way. And I'll give you an example. I was speaking to an agent yesterday, and he mentioned to me that, yes, there's been an increase in demand for units and house prices, and it's reflected in the numbers. However, he's getting pockets of his clients where they're saying to him, please, we're under a lot of financial stress here. We need to sell this quickly. And in those pockets of his clients where they're experiencing that stress, the property is selling below market. So there's definitely pressure in the system. There's definitely households that are needing to deleverage their debt, and to do that, they need to sell property. Other proof of this happening is in winter, traditionally in Australia, the supply tends to decrease because it's not a great time of the year to sell. Buying property is an emotional game, so it's better to do it when the weather is warmer and the days are brighter, and therefore supply tends to increase in the spring and summer months and not in the winter months. However, we've seen a 4% increase in supply over this time of the year, which is very, very unusual. So it seems to be the case that pressure is mounting on households when it comes to their debt commitments. Having said that, there are a lot of speculators in the market, and the speculators in the market want to take advantage of property prices while they're below the highs that we saw in 2021 to the beginning of 2022. And as a result, they're looking through this interest rate cycle, and they're looking into the next one where interest rate cuts will start to filter through. And that looks like it's going to be from the second half of next year, potentially. And because of this, there is definitely demand coming through. So if you're speculating in the markets, it's probably a good time to get into the market, because once interest rate hikes are definitely done, we're moving into the next cutting cycle as the economy weakens, and the bull market will definitely gain momentum, and then prices tend to run away. Hope you enjoyed this week's podcast, and I look forward to seeing you in the next one. Thank you for joining me on this episode of the Valmika Property Investing Podcast. I hope you found our discussion insightful and empowering. If you're interested in finding out more about our services at Valmika Buyers Agency, visit our website at valmikaproperty.com. There you'll discover how we can assist you in making informed decisions and achieving your property goals. See you on the next episode.